Hey Bowtie Nation, Joseph Hogue with one of the most popular strategies on the channel, creating weekly dividend cash flow, because who wouldn't want those dividend checks every single week? In the past, I've showed you how a simple portfolio of monthly dividend stocks work together for those weekly dividends. Now there are ETFs, new funds that can put cash in your pocket, and with yields as high as 62%. 50 times the market average, and even 5 times the dividend on the popular QYLD Income ETF. But which is better? The DIY approach, buying your own individual stocks, or just putting your money into an ETF for that weekly cash flow? I'll detail the 2 weekly dividend funds, how they work, pros and cons, as well as one popular weekly ETF that just imploded. Then I'm going to show you how to put your own stocks together, a simple 4-stock portfolio that also gives you weekly cash and a 13% yield, before comparing the strategies to help you decide which is better. Let's get started with the Roundhill Innovation 100 0 DTE Covered Call ETF, ticker QDTE, a new dividend fund out since March. The QDTE is similar to the popular QYLD Covered Call ETF in that it uses call options to create cash flow to pay dividends, but with a high-yield twist. The fund invests in what it's calling the Innovation 100 Index, and this is actually kind of funny because what it's doing is investing in the stocks in the Nasdaq 100 Index, same as the QYLD ETF, but if it came right out and said Nasdaq 100 in its documents, it would have to pay a licensing fee to the Nasdaq company, which has a copyright on that index. Instead, it set up an equivalent index with the same 100 stocks and avoids that licensing fee. Anyway, the fund invests in the 100 largest companies on the Nasdaq exchange, mostly tech stocks here, and then every day sells call options against the position. Remember, selling call options means you sell to someone else the right to buy those stocks from you at a set price for a set period. And for that, the other investor is going to give you a cash premium right now, a cash premium that the fund uses to pay those huge dividends. An example is going to make this a lot easier to understand. Here we see shares of the Invesco QQQ Trust, the ETF that invests directly in those Nasdaq 100 stocks, just like the QDTE fund. That QQQ fund closed at $480 a share last Friday. Here we can also see the call options available that expire the following Monday, so the 0-day to expiration options. Now, if we sold the calls with a $485 strike price to another investor, that means the other investor would have that right to buy our shares of QQQ for that amount, that $485 each on Monday. Now, for that right, the other investor is going to pay us this 25 cents per share. Now, that might not seem like much, just 0.052% on that $480 strike price, but it's also the single day, and we can do it 5 days a week. If we repeat that all week, that is a 0.26% return, or $1.25 on our shares in cold hard cash. Annualize that amount, so repeat the process every day for the roughly 250 trading days in a year, and you've collected $312.50 in cash, or about a 65% dividend yield. Of course, there is a risk here. Selling those call options, you're giving the other investor the right to buy those shares from you for that $485 each. So if the QQQ rises by over 1% to over that amount on Monday before the options expire, they'll buy them for that $485 no matter what the market price is. So let's say the Nasdaq jumps 2% on Monday to $489.60 a share. You've already sold this other investor the right to buy them for $485, so that's the cap on your return. You still collect and keep that 25-cent cash flow and the $485 option strike for your shares, but you wouldn't see the extra bounce on the market. So that's the risk that this QDTE and all these covered call income funds are taking, as seen here in the fund's marketing documents. That covered call strategy, the graph on the left, caps your potential return in exchange for that cash payment. Sometimes it works in the fund's favor. Sometimes they collect that cash payment and the stock it holds go nowhere or even fall a little. That means the fund is going to keep that cash premium and the shares and can sell more calls the next day. Now, other days when the Nasdaq jumps and those shares are called away by the other investor, the fund has to buy the new shares so it can continue to sell call options against them and collect cash on those for the dividends. But the strategy has worked very well for the fund since March. We can see its dividend payments and calculate the yield here on Yahoo from the historical data tab. Change the time period to max and we see the inception March 6th, and then to show dividends only, and we see every dividend paid since that first one March 26th. Now, one problem here is dividends on these income ETFs are very unreliable. It's paid out as low as 9 cents a share in April and as high as 56 cents a share recently, but you never really know. It just depends on the volatility in the market because those call option premiums rise and fall with volatility, with that market uncertainty. We do see it's been able to pay dividends every week, which is a big change from the normal 3-month quarterly payments we see in most dividend stocks. Now, assuming, and this is a giant assumption, but assuming the fund continues to pay out that same dividend it has over the past 4 weeks, so adding up these last 4 dividend payments up and divided by 4 for an average, we get just under 51 cents a share each week. If it does that 52 weeks in the year, we get a total annual dividend of $26.45, which because of holidays and volatility changes, it won't do exactly this much, but for simplicity's sake, we're going to assume this amount. If we take that annual dividend divided by the current stock price, we get a 61.7% dividend yield, which is unheard of. Now, before you get too excited, I want to show you how this can change so quickly. So let's go back and recalculate the dividend using the payments from May when volatility was lower and those call options didn't pay quite as much. If we add these up and divide by 4, we get about a 20 cents per share weekly payment on average. Then we see the fund was trading for there in mid-June at around $45.75 a share. And if we take that average dividend payment times 52 for the yearly amount, and then divide by the stock price then, we see the dividend yield was only 22.7% at that point. That is still a hell of a great dividend payment, but nowhere near the 62% yield on the other estimates, so you can see how this can all change quickly. Now, I know this is a lot of numbers, but I want to highlight one more weekly fund, the Roundhill S&P 500 0DTE Covered Call, the ticker XDTE, before we talk about pros and cons here. The two funds use exactly the same strategy, except against a different set of stocks, where the QDTE invests in those Nasdaq 100, the Innovation 100 tech stocks. The XDTE holds stocks in the S&P 500 index, so the 500 largest companies based in the US. It's funny again here though, because it explicitly says the S&P 500 index in its marketing. That means Roundhill is paying the S&P the licensing fee to use that index, rather than its approach with the other index. Maybe they just couldn't come up with another name for the S&P 500 index, like the Fabulous 500 index. So just like the QDTE uses a similar strategy with the QYLD income fund, except with those 0-day to expiration options, the XDTE is similar to the S&P 500 Covered Call ETF, the XYLD, except with those 0-day expirations. And so you kind of get a sense that, okay, is Roundhill just copying this ticker symbol from Global X Covered Call funds, the QYLD and the XYLD, and just using the DTE in their ticker? So XDTE or QDTE. We can also do the same dividend yield calculation here we did with the QDTE. Going to the historical data and changing the time period to max, we see the fund started March 6th, just like its QDTE. Changing to show dividends only, we see the payment history and every week back to March 26th, and the same dividend uncertainty. Payments have been as low as 2 cents a share back in April and as high as 41 cents a share earlier this month. Now again, most of that has to do with that amount of volatility in the market, how much prices are swinging up and down, and how much the fund can collect with that option strategy. But if we add up these recent 4 payments and divide by 4, we get an average dividend of 38 cents a share, and times 52 weeks a dividend of almost $20 per share over the year. And again, please understand, this is not what you're going to collect over a year. We've seen how those dividend payments rise and fall from week to week, and averaging the most recent 4 weeks, which have been exceptionally high because of volatility, is without a doubt overestimating the real dividend yield here, but I want to show you how to calculate this on your own. Anyway, if we take that 1-year dividend estimate of almost $20 a share and divide it by the current stock price, we get a dividend yield of 38%, which is lower than the QDTE, but still amazing in the world of dividend stocks. And the difference in those yields just goes back to the stocks each fund holds and the volatility. Nasdaq 100 stocks, so that mostly tech stock index, is quite a bit more volatile. The stock prices move up and down quite a bit more from day to day compared to stocks in the S&P 500 index. That volatility means those option premiums are higher. If you're willing to sell a call option to another investor, but there's a higher likelihood that the stock price could go much higher, then you're going to want a higher cash premium. So that's why the yield is higher on this QDTE versus the XDTE fund. I'm going to detail the pros and cons of these funds next, but I also want to personally invite you to get the Weekly Bowtie, our free weekly newsletter with all the stock market news, strategies, and trends you need to know. Each week before the market opens, I'll show you what I'm watching and the stocks that could highlight the week. It's all totally free, just something I like to do for all you out there in the community. So look for that sign up link in the description below. The biggest upside to these weekly dividend ETFs is just a higher potential yield. Selling those daily call options versus the monthly strategy we see with the QYLD is just mathematically going to give you a higher cash flow potential if it's managed right. And we're going to see next in the cons that it might not be managed. But if done well, you've got the potential to collect dividend yields of 60% from these weekly funds versus less than 3.5% on regular dividend ETFs like the Schwab US Dividend, the SCHD, which I do also like, or even the 12% yield on the Nasdaq 100 Covered Call QYLD ETF. That weekly cash payment also means more motivation and makes it easier to live off your dividends. You don't pay your bills every 3 months, so investors love these monthly dividend stocks, but even easier is being able to depend on getting that cash flow every single week or whenever your bills come due. For those not living off their dividends yet, seeing that cash payment hit your account every week, that ain't bad either. But like we say here on the channel, it ain't all rainbows and unicorns. Both the QDTE and the XDTE charge a 0.95% expense fee, which is a huge fee compared to most other ETFs. For example, you'll pay just 0.03% to hold the Vanguard S&P 500 ETF, the VOO, or 0.06% for the Schwab Dividend Fund, that SCHD. That's a management fee of just 60 cents for every $1,000 invested, as opposed to $9.50 for every $1,000 you'll pay holding the QDTE weekly ETF. Even that QYLD Monthly Fund charges a high, but still lower 0.61% expense fee. Now, part of that higher fee is that the QDTE and the XDTE are just starting out and need to collect more on that lower asset base. With just $128 million in assets in that QDTE, even that nearly 1% expense fee is only about $1.3 million in fees to cover its costs. Compare that with the $50 million in fees Global X collects on its $8.2 billion QYLD ETF. Part of the higher fee, though, on that QDTE is also because that daily option strategy is just more management intensive and more expensive to operate. So even if assets do rise in this fund, I don't expect the expense ratio to come down too much. Now, another downside is going to be a higher volatility in the price versus those monthly dividend funds. We see in both the QDTE versus the QYLD and the XDTE versus the XYLD, the stock price for the weekly dividend funds rises and falls faster. The volatility in those monthly dividend funds is high enough, so if you're one that loses sleep when that roller coaster gets moving, you could be pulling your hair out watching the portfolio on weekly dividend funds. We already saw how that dividend payment can change from week to week. It's a nice surprise when it rises steadily from 14 cents a share in June to a 56-cent dividend in August, but that payment can fall as well. That makes it tough if you're living off your dividends, so definitely a drawback for some investors. Another con, these weekly dividend funds will likely underperform their indexes and possibly even the monthly dividend funds as well. Here we see the QDTE weekly fund versus the QYLD since March, with the monthly dividend fund almost breaking even on a price versus a 4.8% loss on the shares of the QDTE. And it's the same picture in the XDTE, with the weekly dividend fund losing 1.2% of its value over the last 6 months, versus the monthly dividend fund, the XYLD, up 1.9% over the same period. Now, of course, that massive dividend yield makes up for a lot of this, using stock prices adjusted for dividends. So including the dividends you would have collected, we see the weekly QDTE has produced an 8.15% total return over the 6 months. That's higher than the 6.37% total return on the QYLD, though it's still below the 10.3% total return investing just in the QQQ itself. So just buying those Nasdaq 100 stocks outright. So now purely on a price return, you're likely going to see your shares of QDTE fall and underperform the QQQ index and maybe even the QYLD. Comparing the 6 month charts in the QDTE and the XDTE with those monthly income funds, we see the same weakness in the weekly dividend funds in April and again in mid-July to August. When the broader market falls, the QYLD and the XYLD fall, but those weekly funds, the QDTE and the XDTE, fall even harder. And we don't know yet, but it may point to a problem with how these weekly funds are managed. Because the QDTE is buying call options rather than actually investing in the 100 stocks directly, the value of those assets in a fund is going to fall faster as the market drops. It's a more complicated strategy and may contribute to these lower returns if stocks fall, but it's not a guaranteed disadvantage. It just depends on how the funds are managed. We see one more major risk with these new weekly funds in the implosion of another fund last February. Investors in the SoFi Weekly Dividend ETF, the ticker WKLY, woke up to hear that their fund would be shutting down and no longer traded. This is almost always because the fund couldn't attract enough investors and increase that net asset value enough to where the expense fees covered their costs. For example, I can almost guarantee you that the roughly $1.2 million in annual fees the QDTE is right now collecting off of its $128 million is not enough to cover those expenses plus salaries. That does not mean the fund is going to shut down, only that it needs to attract more investor money, and it does appear to be doing that. It is a risk, though, in these new, smaller ETFs, and when a fund does shut down, the current value of your shares is returned to you, but that's going to mean tax implications, just as well as just finding a place to reinvest your money. I'm going to show you that do-it-yourself approach to weekly dividends next, but first, I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. I've shown you how to set up your portfolio for weekly and even daily cash flow in the past, buying dividend stocks that pay out so you receive that constant cash flow. I'll compare these strategies next and help you decide which is better for you, the do-it-yourself approach versus investing in these weekly dividend ETFs. But the DIY approach is easier than you might think. With just 4 monthly dividend stocks, you can create a portfolio that pays you every single week. It works by going through your favorite monthly dividend stocks, going to the dividend history, and then just noting which weeks they typically pay. Since most dividend stocks keep an extremely consistent schedule, this usually means paying out in the same week of each month. So you go through your list and map out which weeks each one pays. Then, putting them all side by side for when they pay out, you can choose a stock or an ETF to buy for each week and plan out your cash flow. In a recent video, I selected shares of the JEPQ, ARR, PFLT, and SVOL for a model portfolio and a combined 12.7% dividend yield. Now, of course, you're not just blindly buying stocks by each week they pay out or the dividend yield. You still need to analyze each to find the ones that you think can produce that higher cash flow, but also the price appreciation kicker. I'm going to link to a full video in the description below for more detail on how to set this up, including that daily dividend video. And for that 4-stock portfolio and the 12.7% dividend, stocks have largely traded flat over the last 3 months since, with ARR up 3.9%, but the rest of them down slightly. It's a higher dividend yield than QYLD and has beaten the QDTE on that price return. I'll help you decide which strategy is better for you, those weekly dividend funds or the DIY approach next, but if you're hoping to live off your dividends, you won't want to miss a new series on the channel and this video, the 10 highest paying monthly dividend stocks. I dig deep into the free research reports on the highest yielding stocks, show you how to analyze them and how to find the best, so make sure you check that out next. Now, I'll admit, I've been a skeptic on the QYLD Covered Call ETF in the past for its massive share price loss versus that Nasdaq 100 stocks. Yeah, the 12% dividend looks nice, but you could have just invested in the QQQ and made 180% more over the last 5 years. Here in this monthly dividend fund, you see the same dividend uncertainty, and the payment has come down regularly. And this weekly dividend QDTE may be just as bad on price, with it down almost 5% since inception and a loss of 15% versus the QQQ, but that dividend yield is hard to ignore. Even at its worst, the yield on the weekly fund was around 20% annualized versus 12% on the QYLD ETF, and lately, it's been paying out that upwards of 60% yields. You could try to reproduce the same daily covered call selling strategy on your own, selling those 0-day call options and collecting the dividend every day, just like our explanation earlier. That is a lot of work though, and I'm not sure it would be any better than the results we see with this professionally managed QDTE. So for that high yield, I think that's the way to go. But if you're willing to accept a slightly lower yield, I think the do-it-yourself approach is still a great option, buying those monthly dividend stocks directly. Depending on the stocks you buy, the dividend yield can still be a very respectable 10 or 12%, and here you'll have more opportunity for price upside as well. Maybe it's just personal preference though. I always defer to having some more control over my own investments, so investing directly rather than a fund. It's more work and more complicated, but I save on that management expense, and it's what I enjoy anyway. If you don't want to pick your own stocks and manage the portfolio, something like that QDTE or the XDTE can get you those high weekly cash flows in exchange for maybe a little added expense. Stay ahead of the market with all the news, strategies, and trends you need to see with the Weekly Bowtie, our free weekly newsletter with the invite link below. Or click on the video to the right for the 10 highest paying dividend stocks right now. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.